Hello and welcome again to Money Tips. This is Charles Kelly, bringing you money tips to help you save, earn, invest, accumulate and enjoy more money. Well, how's your new year going? How's 2022 going for you? I hope it's better than last year. There is some good news around. The new variant seems to be an indication that it could be the last of the COVID variants, and it could start to, the deadliness of this variant could be much less than previous variants like the Delta, and we could see the whole thing fade out or fizzle out as we go into this year. And certainly economies are starting to pick up, but it's not all good news for everybody. Prices of everything is going up. Inflation in the UK, fuel, and all over Europe actually, fuel and gas prices are going through the roof, and in some cases doubling people's energy bills. And we haven't, the economy has gone through a rough time, so it's going to take time to come back to where it was. Now, interest rates have already risen in the UK late last year, and we feel that they could go up again. This is to curb soaring inflation. Inflation is over 5% here. It's over 7% in America, the highest in 40 years. And the Federal Reserve over there, which is like the Bank of England here, I guess, the central bank who control interest rates, said they will probably increase rates 3 times next year, but not until the middle of the year. Many people feel that it will be earlier than they originally predicted. So we will have to see. All I know is that despite the fact that they say it's only 5% inflation here, just over 5%, we know that stuff is going up more than that. I mean, I had a bill from my Wi-Fi supply, Virgin Media, and they said, Happy New Year, and by the way, we're going to increase your bill by £3 a month. Well, that's around 10% of what it was, what it has been so far, 10% increase. Now, what's that based on? Are they paying 10% more for their energy or for their supply of Wi-Fi? I don't get it, So, and this is just one of many bills that are going up. We know that the prices in the shops have been going up. Fuel, oil is almost at record prices. So things are going to be tough for people this year. But at least we're seeing a bit of light at the end of the tunnel. Although when you see light at the end of the tunnel, it can be the headlight of an oncoming train. So do watch out for that. So if interest rates do go up, though, maybe it's time to think about fixing your mortgage deal. Are you on a fixed rate, or are you on a discount or a variable rate, which can go up or down with the wind? Just check that, because there are a lot of people in the last few years who've taken out mortgages. Most of those will be on fixed rates. But what about if you've got an existing mortgage from a few years ago? Maybe your fixed rate has expired. Maybe you didn't bother to renew it. So do take a look at that, because if rates go up, you could be hit significantly, and maybe now is the time to fix rates. And in some cases, you can fix the rate at lower than you're paying on a variable rate. Like for instance, HSBC are offering 2-year fixed rates as low as 1.29%. That's almost 1%. It's incredible. And all right, for 5 years, you might have to pay a little bit more, 1.43% with the Halifax. I mean, that's 1.5% fixed for 5 years. And 1.43, if you're on a variable or another rate, I bet that's less than you're paying now. Now, those particular rates are headline rates. It's only available for people who've got 40% equity in their property. It's only up to 60% loan to value. So, if you owned a house worth $1 million, you can only borrow 600,000 on that rate as a maximum. And yeah, this is for residential mortgages, but there are similar deals around for buy-to-let investors. And I don't think we're going to see deals like this for a long, long time, because we've had record low interest rates since the last financial crash, and they really are artificially low. They've been kept down artificially, and this affects what the governments pay on their debt, and inflation, we know, is going up higher than the official rates. And again, they've tweaked and fiddled with the official inflation rate, because this affects how much they pay on social security benefits and pensions, and pension rises each year. So pensioners and people on social security in this country and the US are effectively being screwed by these new type of ways of calculating inflation. And so this means that prices are going up faster than their pensions, and their pensions, their state pensions, and all the rest of it are not keeping up with the price rises. So they're in a difficult position, and you eventually get to a stage where you have an old widow in a house, and it's a big property, but she can't afford to heat and eat. Now, there are ways around that. You can take out equity loans against your property, but a lot of people are not even aware of it, or they just don't want to be bothered, and they're worried about leaving stuff to their beneficiaries, their children, and that sort of thing. But I think if you're in that situation, you should at least go and talk to an advisor about taking out some equity out of your home, and then using that money to live on, to spend, maybe to do the house up, to renovate it, and get on with your life, rather than sitting there worrying about how you're going to either eat or heat your big old house in the winter. So do think about that. But I'm not advising you to take out a mortgage on your property, but they're on the TV now. They're virtually throwing money at people now. And what happens with these equity loans, just to quickly divert into this, is that let's say you've got a home around London worth £1 million. You could borrow £200,000-400,000 against that property, and you might not need that much. You might say, well, I only want 100,000, and that basically the interest on that loan will roll up, or you can pay the interest monthly, and it will be paid off when you die. So it's an ideal situation. It actually means that you could actually borrow that money, give it to your kids to buy another property, and save on inheritance tax when you die, because your estate will be that much lower when you pass it on to your relatives, your children, grandchildren, whatever. So it's actually so do take financial advice on this, because it could transform your life literally. Now, a lot of pundits at the moment are saying, will stock markets fall? One guy I follow, Harry Dent, he's been saying the markets are going to fall in January. Well, he was saying this like last year, from the summer onwards. Every month it was going to be another rally, and then it was going to go down, and then it was October, and then it was December, and now it's January. But a lot of punters now are joining in with this. A lot of people are saying that the markets between now and April, as the Federal Reserve in America start tapering how much they're pumping into the market, the markets will be in for a correction. Some are saying a correction, some are saying an almighty crash in the proportions of the 1929 stock market crash, and then it could take years to recover. And I'm not advising you what you do, because it's end of the day, it's your money. I don't know your particular financial situation. You might be in good safe stocks that give you an income, but I personally wouldn't be putting all my money into the stock market, and pension fund money as well. Now, you might think, I don't invest in the stock market, but your pension fund that you're in is probably invested in the markets. 60, 70, 80% of your money is probably in that stock market directly. Now, look, I could be wrong, but markets could still go higher as the financial system and the central banks keep pumping money into the market. And they've really got the markets on life support machine. Now, I could be wrong. Markets could go higher, but I'm prepared to risk that rather than risk my money and then the market goes lower. Because if the markets go up by 10%, I've lost 10% growth. But if the markets went down by 10%, I've lost 10% of my actual capital. I've lost money. And that's the rule of investors like Warren Buffett and his guru Ben Graham and other gurus around like Phil Town. They're called Rule 1 investors. Rule 1 is don't lose money. Rule 2 is never forget Rule 1. So they're cautious investors and value investors. They look for value stocks at the right prices. And that's what Warren Buffett does. That's why he's sitting on over $100 billion in cash, waiting for the market to go down or waiting for the right stock to come up. And he said he hasn't been able to find any good value stocks in the last few years because prices keep going up and up and up. And he feels that they're frankly overpriced. So that's you have to make your own financial decisions. I'm not your financial advisor. Now, what about property? Will property prices go down? Well, property is a different matter. It's not people speculating and gambling like they are in the stock markets at the moment, and everyone's saying we can make money on the stock markets. We're doing options trading, futures, and all the rest of it. It's very different with property. most property is lived in by people. You need somewhere to live, and people will always need somewhere to live. And look at the last 50 years. Wealth, life expectancy, and population have all gone up. They've all increased, right? The population of the world has increased enormously. And in parts of Africa, they're expecting the population to double in the next 30 or 40 years. So, people need somewhere to live. And look at wealth. Look at how China has taken 1 billion people out of poverty in the last 50 years and become the second largest economy in the world. Now, I've traveled in a lot of countries in Asia in the last 30 or 40 years, and I've seen how things have changed. Places that were really, almost dirt poor, where, your pound could just buy you so much, have caught up with the West. Now you go there, you're paying near Western prices for things, for hotels, for restaurants and drinks and that sort of thing. It's still cheaper than the UK, but not as it was then. In those days, you could have just bought land and property for really low prices. And certainly, with a few dollars in your pocket, you could go out for an evening and barely spend it, on meals and drinks and that sort of thing. So, and everything was really cheap, even hotels. And now it's not like that. Now, I've seen how their economies have changed. There's a bigger middle class there. Before there was a few rich at the top and everyone else was poor. Now there's a middle class growing in these countries, whether it's the Philippines and or Vietnam or whatever, and China obviously. So I've seen how it's changed, and that's created a lot of wealth has been created in the last few years, and that's pushed up prices of things like property. So where will it end? I mean, we've seen properties go up since 2012. They don't go up forever. And at the end of the day, affordability will affect the market. When prices go so high that people can't afford them, then they have to come down. And interest rates is another factor. We know that if interest rates go up, it will affect the stock market and it will affect the property market, which is why the government is holding back on raising interest rates again. And also the government will have to pay more for their debt. So if that happens, and we know that interest rates will eventually have to go up, markets could slow down. But property prices, if you go back to charts over hundreds of years, they've always gone up in an upward direction, but there have been dips. You'll see dips, a bit like the stock market. So just because there's a big demand for property, it doesn't mean they'll always go up. There will be times when property prices go down, and they could stay down for 2, 3, 4, 5 years. I've seen pretty bad property recessions where they took years to recover. And so if you bought at the top of that market, it took a long time to get your money back, in other words. But if you have a low fixed interest rate and you have a good job, regular income, and you're living in that property, you should be fine. It doesn't matter whether your price of your house goes up or down. People have got to talking around the dinner table about their property prices all the time. It's become like a national habit, but it doesn't really matter if you're living in that property for the next 5, 10 years. Even if it goes down, it will come up again. And also if you're an investor and you've got a good tenant in there, you've got rental income coming in, a good fixed rate, a low fixed rate, which rates are low now, then what does it matter if the prices are going down? If you're investing for income, you will still get that income in, unless there's an almighty crash of everything. But let's not look at the doomsday scenario, because I don't think it's going to be a doomsday situation. So if you're a prepper and you're really into this doomsday, I don't think that doesn't really add up for me. But I know a lot of people. I respect your opinion, but property is a good deal in the long term, and a lot of people are still putting their money in property because if they leave their money in the bank, they're earning next to nothing. Whereas you can put your money in a property and earn, even in London, a 3% yield on that property, maybe a little bit more in the places up north. So, if you want to find out more about property, contact me and we can talk about how you can get into property if you're a newbie, a new investor. Got lots of ideas on that, lots of courses, and can take you and hold your hand through that. So do let me know if you're interested in that. Now, while we're talking about property, and I just briefly mentioned the Philippines, I was doing business there years and years ago, and I've been there a lot in the Philippines. I used to recruit staff nurses from the Philippines, and some areas just seem to get hit with these typhoon disasters. Now, one particular area is an area called Surigao at the moment that has really been hit badly. Now, they're not normally on that typhoon kind of area, So, but this year they've had a really bad, just before Christmas, when we're all sitting down to our Christmas dinners, they were really hit by a big typhoon. It's destroyed about 90% of homes. So I've got a little fundraiser going on through Rotary Club. So it goes into our Rotary Club, Not To Me, and you can find that on Facebook, and I'll put a link up there. So do have a look at that. Any little donations will help, and it'll all go directly to the people who need it via Rotary Clubs. There's no big administration fees taken out of this. As you know, this year I've also launched a new book, Borrow and Grow Rich. And, you know, quite frankly, you can borrow money at very cheap rates and buy assets like property, and over the long term, you will grow rich. So I've got a special offer on this book. You know, you can read the first couple of chapters free. If you order the book, I'll give you a copy of my last book as a PDF, absolutely free as well. So have a look at that. And, you know, remember that financial education is the key in everything, really. When it comes to making money and keeping money, it's everything. So do have a look at that. And, you know, if you want to make this year your best year ever, then I'm going to put up some on-demand free training for you to take you through how you can really turn your finances around and make this your best year ever. So click there, you can watch that absolutely free. So thanks for listening, everybody. I want you to all have a good financial year this year, better than last year. And let's all have a good year, get back to normal as soon as possible, I hope, and stay safe out there.